Okay, so we are in lecture 5, meaning that we are more than halfway through already, just actually one more lecture. So, as you have recalled, the I'll just do a quick recap as you have recalled what we have covered so far. So, lecture 1 was the qualitative aspect of valuation, and we did look at a full valuation report on a manufacturing company in Singapore. In fact, I think it's listed in SGX as well. And we went through all the various qualitative frameworks that we can consider. So remember, you don't have to use all of them. Choose the ones that is best for you, right? And then we move on to lecture 2, where we cover like a broad overview of all the quantitative, right? Uh, Quantitative tools. And then we talk about tools like the simplest, which is the DDM. And then we were talking about the FCFE, FCFF, uh, and residual income, right? And then lecture 3 was more of the details of DDM, and 4 was details of FCFE, right? So, as usual, the structure of our today's lecture, we'll do 2 breaks, if that's okay. If everybody will do the same format, so 2 breaks, maybe 10 minutes each. And then today, the focus would be on residual income. So we'll cover the details of residual income. It's slightly different because that's the residual income is based on economic profits, so not like your CFFE or FCFE or FCFF. At the same time, we'll talk about this thing called uh, technical analysis. So we'll look at some graphs, we'll try to understand it. But I believe if you have already started looking at assessment, uh, technical analysis is not really a big component. So it's really just good to know if you do want to write your evaluation report, a bit about technical analysis, that's fine. But most of the time when we think about technical analysis, later when we cover, it's more on trading. So valuation report tend not to be so relevant. And so if you already started looking at your ECA and stuff, you know that technical analysis is more of as a good to know kind of knowledge, right? So before we begin, I guess if there are any questions, feel free to put it in the chat, right? Okay, so let's kickstart today's lecture with residual income. Um, uh, the first few slides are kind of more of a refresher because we covered residual income as a broad overview in lecture 2, which is quite a while back. So let's just do a bit of recap of what is residual income, right? So residual income is not cash flow, right? So we're not talking about the FCFE or FCFF, although there's some similarities and we'll see it later. Right, so residual income is more of the increase in the shareholder equity, and the reason why this is so is because if you recall residual income, we have this B naught, right, which is the book value of equity, and then we plus the PV of RI, right, present value of your various residual incomes, and this will give you the value of the firm, right? So this is how we calculate value for residual income. And so because of that, if you notice, we are actually focusing on this, your B naught, and the residual income is not really like a cash flow. It's more of a economic concept. Um, so just a small recap, accounting profits is revenue minus costs, right? There's accounting profits, but of course, when we think about accounting profits, more the explicit costs, such as cost of goods sold, administrative expenses, etc. But when we think about economic profit, there are quite a bit of more implicit costs that we have to take into account. These costs could include, opportunity costs, op costs, or even, cost of equity, right? Cost of equity. So just a question: is the cost of debt reflected in a accounting profit? So I repeat the question: is the cost of debt reflected in your accounting profits? Then does your accounting profits already take into account cost of debt? Mm, okay, we have probably own interest. So it's okay, it's a mix. Yeah, so it's yes and no, I guess. Yes, in a sense of interest expense, right? That is the your main cost of the debt. Of course, you have your actually, it's not a yes or no. Actually, it's more of a yes, for sure, yes. Why? Let's think about it. Yes, interest expense is the main component that is capturing the cost of debt, right? And that's why some of y'all were thinking about, oh, let's take total interest divided by total debt, then you get the cost of debt. So it's kind of true. Um, and the amount of interest also reflects the other risk, right, that we need to consider, like, for example, counterparty risk, default risk, which is all inbuilt into amount of interest that, let's say, a bank would charge the company, right? So yeah, cost of debt is kind of reflected in the accounting profits already. Um, and the reason why uh, we cannot use that method of interest divided by total interest divided by total debt is because in WACC must be forward looking. We need to use the market values, and using the accounting numbers are of course incorrect because they are historical, they are backdated, and that's incorrect, right? And we have a whole discussion on that in lecture 2. Now, how about the cost of equity? Is cost of equity reflected in your accounting profits already? No? Okay. We have a no here. Yeah. Okay. Yeah. So I think all of your kind of caught what I said earlier as well, because there's a more implicit cost. Remember, the only component of equity that we really consider in the accounting profits is more of dividend, right? But dividend is more of a redistribution of wealth. But if we think about it, there is actually no like cost that we take into account in terms of like kind of interest, or like in the sense of, oh, what if the shareholder pull out their shares, right, and want to sell their shares. So what is the risk or the associated cost on this risk that we have to account for? Yeah. So if you notice, there is nothing that is capturing the cost of equity in the accounting profits, and uh, that's why economic profit comes into play, right? Because economic profits take into account both implicit and explicit cost, and your explicit cost implicit cost relates to your cost of equity that you have to consider, right? So now I hope you can see the reason why residual income is important, right? So imagine if you just use the free cash flow model, right? If you think about let's say the free cash flow to firm, then we have to consider both the firm and equity. But in a sense, when we do the cash flow and all, we try to adjust and consider the cost of equity. But if we just plug the numbers directly from, let's say, the cash flow statement, which is of course incorrect, can't do that. We did last lecture. You notice that we try to do some adjustments here and there to make sure you take into account the cost of equity. Okay, so income statement reflect earnings available to two owners. Available to owners, fine. Uh, Net income reflects the interest expense, which is cost of debt. There's no change. There's no representation basically on the cost of equity that we talked about already. Residual income deducts the estimated cost of equity. Okay, so when we think about residual income, right, it is quite akin to the FCFE in the sense that we are interested in the so-called the residual income to equity holders. Okay, so later we'll talk about this thing called EVA, enterprise value added. So that one will be more of FCFF, right? So now when we think about residual income, try to imagine it to be similar to your CFE, right? So we are just focusing on the equity holders. Now, I believe this is not new. We have seen this in lecture 2. I'll just do a quick recap of how do you even calculate residual income. And again, I like to bring in the idea of more of like what's the intuition behind residual income first before we go through the formula, right? So the intuition behind residual income is simply this, right? So it's simply actually this, where we have the return on equity, right? ROE. So we have what is the equity holder getting, right? The returns they're getting. And then we have the cost of equity, right? How much would um, it cost the company to have these equity holders or these shareholders, right? So what it simply means is that, if we take the return minus the cost, right? And then you multiply it by the book value of equity because your return is per equity, right? Your cost is also per equity. So you just multiply it by what is the book value, and then we get the income, right? What is the remaining income for the equity holders, right? So it's a simple concept of the returns minus the cost, and then you multiply it by the book value because your return minus cost that is per equity, and therefore we get the income to the equity shareholders. So that is the basic concept of this. And how do we even derive this formula? It's actually derived all the way from this, more condensed formula of, let's just take the net income for the year minus the equity charge, which is, why is it highlighted in yellow here? It's T minus 1, right? Because it's always one period back, uh, because it's called equity amount 1 year back is how much the money was being used, right, by the company to invest and to generate income. That's why it's always one period back, T minus 1. Okay, so if you notice the link between net income and expected EPS is just basically just the net income divided by number of shares. And so equity charge is basically the book value of equity times cost of equity. So, I just want to expand on this a bit. How do we get, just erase this. So how do we get from here to here, right, in terms of the formulation? So remember, return on equity is what? Return, which is net income divided by equity, B, minus cost of equity, right, COE. And I want to multiply this by book value of equity, right? So if you do notice that when I do the, when you learn in secondary school, the bunny hop thing, where you multiply it in. So if you do notice that the book value of equity, when you multiply into here, kinds of cancel out here, right? So you get your net income. You get back your net income. And then as your book value of equity multiplied into the cost of equity, basically you get your equity charge. Okay, equity charge. All right, so you eventually what happens is you get back your initial formula. Any questions regarding how we formulate this various types of formula? So, you need to, of course, know how to use either or. Sometimes the questions can give you terms of ROE. Sometimes they give you net income. So you don't need to use the right one. And I hope you do remember how to calculate cost of equity, right? Remember, there are 3 methods. So 3 methods calculate cost of equity. Right, we're good. Okay, perfect. So that's how we calculate residual income. But in terms of valuation, using residual income for valuation, recall in the start of the lecture, I did mention that it's does B naught plus PV of RI. RIs, right? There are many RIs. So the idea of it is that we have the value of the book value of the company, right? As a B naught, right? And so what is the valuation of the company? Basically, we have the current value, we add in all the value that we expect to get, right? In terms of a PV of RI. So that's how we get the value of the company in total. So the current value plus what we expect in the future that is going to be added in. So that's what we are doing here in terms of the valuation model for let's say in this case, the most simple case, no growth current scenario, right? Current value minus the plus the PE of the future residual income. And so this is the formulation that we just talked about, that we can either consider the net income, all right, or earnings per share, or we can use the formulation of ROE. So I just want to highlight here for this part, all of you understand this, right? So this is basically just the summation. Basically, you just take PV of residual income in year 2, PV or residual income year 3, PV residual income year 4, and it's just what it's the same is that you just add them up together as a summation. All right. So remember earlier I did mention that, hey, you know what, the residual income model is very similar or akin to the FCFE, right? Which is the free cash flow to equity. And we recall last lecture, we did mention also that FCFE is a special case of a DDM, right? So DDM and FCFE is actually kind of similar. And I know there are some questions regarding, hey, you know, can we use either FCFE or DEM for valuation of a firm? We can. And sometimes you might even want to do both and take an average, right? If you think that there is some purpose in doing that. So in this case, given that the residual income is quite similar to FCFE because we are focusing on equity holders, we can actually do a proof. So I want to highlight at this point that this proof you do not need to memorize, it's just for understanding, right? How they actually relate. And how they relate is through, let's say we take a simpler case of FCFE, which is, or specialized case of FCFE, which is the DDM. It's basically in the DDM model, we know that we're just discounting all the dividends back to year 0 to find the value of the firm. And we understand the clean surplus relationship. Recall the clean surplus relationship is simply the retained earnings formula. I'm just going to write here, RE1 equals to what's the retained earnings in year 0 plus net income. Net income minus dividends, right? So your clean surplus relationship is basically the same thing as a retained earnings relationship. And so because we know that if the clean surplus relationship or the retained earnings relationship is respected, then what we can do is that we can just plug in, or we just do the kind of like a manipulation to get it in terms of D, right? And then we just plug it in here. So we substitute this inside for D, and then we get this valuation, which is kind of what we see in the residual income formulation. All right. So for a residual income model, we are also going to look at a couple of things. Similar to what we have done previously, we have a stable growth. Just now we talked about no growth, and we have a two-stage. Very similar to what we have talked about in the past two lectures, one in the DDM side and one on the free cash flow side. Right. So in terms of a stable growth model, it's kind of a revision as well. In case you do have any questions, feel free to stop me. In terms of a stable growth, we know that it's just a single stage, right? We're just growing at a stable stage. So what we do is to value under the residual income, we have the book value, same thing, and then we add in all the various residual incomes, right? But in the residual income, since we know that it's a stable growth, basically what we are adding on is a growing perpetual. Now, there is a small question here in gray that I like to pose to everybody. And um, you know, hopefully you can figure out like why did we not remember the growing perpetuity formula is what? Growing perpetuity is always if we use the dividend side is D naught, right? Sorry, D1 divided by R minus G, where D1 equals to D naught plus 1 plus G divided by R minus G. So the question is, how come in this residual income model, we did not consider the 1 plus G here? No, but we are using a growing perpetuity. So growing perpetuity is also constant growth, right? It's a constant growth model. So it's the same thing, right? Remember this is also a constant growth scenario, right? It's a growing perpetuity at a constant rate, right? It's uh stable, so it's a stable growth scenario. Mm, stable, no, but then if you flip back to your FCF F or FCFE, you notice that we did have to make sure that it is the so-called F FCF CFE one, right? Okay, yeah, I think you're getting there. So I can see that yeah, resident comes how well ROE performs. Yeah, you are kind of getting there, yeah. Right, look at stable growth potential. Okay, so we are kind of getting there. Now, why did we not take Ri minus G? So it's actually even simpler than that. So let's see why, right? Recall, okay, so how do we value a firm using residual income model? What was the two things that we have to add together? Just now I did mention, which is what plus what for residual income, to residual income valuation. So again, for residual income valuation, uh, what do we have there? Current PV, yeah, very good, and PV of future RI, correct. That's perfect. And do you notice something? Your PV of future RI, it's already your future. So it's not your current. So it's already so-called your RI1, right? It's not your RI not. Not is the current, right? So RI not is the current. Because yeah, yeah. So now you notice, yeah. So I hope all of you all can appreciate this because sometimes if you do not understand this, you kind of like, oh, everything must multiply by 1 plus G, or everything why sometimes need multiply, why sometimes don't need multiply. But in the residual income valuation model, we are taking B naught or book value current plus whatever future residual income we're getting, right? So in terms of the future residual income, it is already RI1, which is the future, because of how the model is being created, right? So yeah, hope you can appreciate this. So if you do recall your TMA in your FCFE in terms of TMA, we did need to multiply by 1 plus G and all those things, right? In order to calculate the terminal value. And that's because of the way the FCFE was being or is being used, right? So you need to multiply 1 plus G and then we bring it back. If you in your TMA, you need to bring to calculate the terminal value, and then we need to also discount the terminal value back. So in this sense, yeah, Ri is already Ri plus. Sorry, it's already the Ri one. Okay. So this is an important point to take note of. Okay, so in terms of a multi-stage residual income model, I don't think we'll go into much details, but the concept is exactly the same. Basically, what are we doing? So if it's a multi-stage, let me just have a look whether we okay, we have it here. Okay, so in a multi-stage, there are a couple of assumptions here, which is very similar to your assumptions used for your FCFE or FCFF or even DDM multi-stage, right? So the residual income will continue at the same level, meaning a constant growth. That means a growing perpetuity, right? In long term, so it's a growing perpetuity. Residual income is zero at terminal and remains zero afterwards. So what does this mean? The residual income is zero at terminal stage and remains zero afterwards. So it basically means that it assumes the ROE to be same as the cost of equity. So remember, this is like quite similar to like the offset that we talked about, right? Remember the offset in terms of your NCS, right? Your net capital spend and your depreciation, right? There's an offsetting that's happening here. So ROE will decline over time to reach the cost of equity, meaning that it's actually going back to here when there's an offset that happens, that they no longer, one is no longer higher than the other. So in this sense, I just want to bring in the graph that we have always used for two stage. So it's exactly the same thing. So what's happening here? We have your book value, which is always there for a residual income model, right? You have your book value, current book value. And what do we do? We have the various residual income in the first stage, right? Residual income in the first stage, meaning the first stage here. And how do we do that? It's basically just taking the residual income, let's say for 5 years, right? 5 years residual income, we discount it back, right? Subsequently, what happens thereafter? So thereafter, we are doing a growing perpetuity, right? So we're doing just now what we did for the stable growth, which is just a growing perpetuity forward. And why do we do this? Anyone can quickly kind of explain why do we need to divide by 1 plus r to the power of n? Yeah, to calculate PV. That's correct. Totally correct. To calculate PV. So we just need to bring everything back. We need to so-called PV the terminal value, right? But we don't quite terminal value here, but we need PV the growing perpetuity residual income all the way back. Yeah, correct. PV of TV. Yeah, correct. But in this sense, we don't quite PV because it's not really like a cash flow because they are economic income. Yeah, but that's right. So the concept is exactly the same. Just want to highlight one more time that we need to consider P naught here. And if you notice, I think we have kind of alluded to it in lecture 2 or even in lecture 3 that the difference between the residual income and your FCFE, FCFF is that for residual income, what happens is a lot of the value comes from your book value, right? So this book value has a lot of weight, which might be a good thing because they are like based on audited statements. However, it's like historical, so maybe not so good. But a lot of weight comes from that. And if you notice that for your previous two or three, cash flow models, a lot of value comes from the terminal value, right? I think we mentioned this a few times, and particularly the growth factor of your terminal value, G. So GEL, right? Growth at low stage. So this is the unique part of the two models, and if you can actually get similar valuation using both the free cash flow model, right? Whether it's in the FCF, it should be the FCFE because we can, if we are using residual income, we should only compare with FCFE because both of it are towards the equity holders, right? So if we get similar values from FCFE, DDM, and residual income, that's a very good indication that your valuation is kind of on the right track. So at this point in time, I just want to highlight one more thing, one last thing is that if you notice at the high growth stage, right, we did not consider the growth factor in the so-called the residual income formula, right? So remember why? Because residual income is your economic profits. We are not using the growth factor to let the residual income grow. Remember, we always fall back on whatever is in the financial statement, which is just the net income minus the equity charge, right? So if you notice that we did not use the growth factor here, the high growth factor to calculate. But this is very different for a free cash flow model. Um, uh, I hope that you remember or recall that for a free cash flow model, we always use the, or not always, or most of the time we use the growth factor to help us determine the cash flows, whether in the high growth or the low growth stage. So this is a unique thing about the residual income as well. So uh, you notice the growth is only used at to calculate this part here, right? Growing perpetually. Okay, so we did talk about the requirement that the clean surplus relationship holds. So, what does this really mean? So the book value of equity, this means that the book value of equity can only change by addition of the retained earnings and nothing else. So that means we can kind of only use this kind of model when there is no such thing as capital injection, which is kind of most of the time there might be some capital injection, stock options or stock buybacks. So basically anything that will affect the equity that is not relating to the increase in retained earnings, right? So if there is in fact some stock options, stock buybacks, usually what have to be done is some adjustments to the financial statements before we use the numbers in the financial statements for um, for the calculation of residual income. Right. So this is just a repeat of what we talked about. Uh, how do we value using residual income, which is just book value of equity and future value of present value of residual income. So nothing too much to talk about. Okay, so this again is to explain to you that residual income (RI) is kind of similar to your FCFE, which we know is a special, the DDM is a special case of the FCFE, right? So these three models can kind of relate together, right? So we should not compare residual income to FCFF, right? Because FCFF is to the firm, but residual income is just really to equity holders, right? So this is just an important thing to take note of. So if you are comparing residual income with FCFF, or let's say you do a valuation, you take residual income plus FCFF divided by 2, that would most likely be wrong, right? Because it makes no sense. Why are you taking firm for cash flow and then equity only for residual income? So that does not make sense, right? So we cannot do that. So there are some cases where residual income is quite good. Of course, it does not pay dividends, negative cash flow. So when there's negative cash flow, um, it's kind of better to use residual income because if you use free cash flow for negative uh, negative cash flow firm, you kind of tend to get all the negative value, and that doesn't make too much sense, right? If you say your valuation of the firm is negative, right? Then why do you even value the firm in the first place? Of course, there's great uncertainty in terms of forecasting terminal value as we talk about it, because your free cash flow models really place our emphasis on terminal value, in particular, forecasting the growth factor, right? Because we know that what is terminal value? Terminal value is a growing perpetuity, which is strongly affected by the growth factor here, growth factor G. Okay, course, when clean surplus holds, which use as income, terminal value contributes a large proportion. So, a couple of strengths of the residual income model. We know that the terminal value does not make a large proportion because the so-called terminal value is just the PV of RI, which is growing at a stable rate, right? Which is what we talked about. Of course, we use accounting numbers. Firm, if they do not pay dividends or they have negative cash flow, yeah, can choose residual income. If cash flow is unpredictable, it's residual income focus on income and profits, which talk about the implicit as well, right? The implicit costs here. Some weaknesses, of course, accounting numbers tend to be more historical. They are not current. We can do adjustments to make them more current, but those will be so-called, we do some adjustments that we talked about previously in lecture 1. Do you recall about like capitalization of the leases, capital commitments, etc. So there's some adjustments that we do. Significant adjustments may be made. All right. Clean surplus relationship holds, and when book value or RI are not predictable, then we cannot use the rest of it. All right. You know what? Actually, there is one small point that I suddenly remember about this. Like, I know that for the GBA, most of you all probably are already using annual report. I want to strongly encourage you to look at the quarter end numbers as well. All right. So this is just a side note. Why? Because as you have noticed, whenever we talk about finance in general, even in this case of residual income, we are very interested in the current numbers, and we always criticize things like, oh, the accounting numbers are not up to date, right? And it's kind of true. If you look at annual report, the numbers are for last year, and we are already in October. So if we are going to use last year number only, your valuation would most likely be very off, or you did not consider most recent data. So I highly encourage you to bring in recent, on top of course, you need to look at the annual report, but you need to bring in the latest, yes. And I believe now for SGX, the requirement is to have half year filing, and quarter year is on volunteer basis. So they might have some numbers, but they are not in details. Details meaning there's no notes to financial statement. But you should be using both the annual report and the quarter or half year numbers, right? Because as we mentioned in this lecture as well, the criticism of using accounting numbers is always that it's not latest. So if we are still relying purely on last year's annual report when we are already October this year, that is very backdated. So it's not good. Right? So yes, use whatever that's latest, but we do need to use the annual report. Because remember, annual report gives you a lot of details, right? A lot of notes to financial statement, explain to you every line item. So we do need to use that as a basis, but we need to supplement it with your quarter end numbers to bring your annual report numbers up.
Hi, Prof. Sorry, thank you for the question. James here. So I think you mentioned just now with regards to the latest data, right? So I understand that I think there were some, like, let's say, article by Financial Times that came out with regards to the bearish outlook of the SIA. So do we have to take that into consideration as well when we forecast our revenue segments and stuff?
So if you have some outlook so-called reports that you have read, those will be under your qualitative component of your valuation, and you can use that as some certain assumptions for your forecast. Your forecast, your cash flow forecast. You can do that.
Understood. So in other words, it would be best to have the latest information, like the latest with regards to all the qualitative analysis and how it ties to our forecasting, right?
Yeah, correct. So it will be
Okay,
good
thank
to
you
have
so
your quarter numbers, and then various reports that will tie into your forecast. Yeah.
much. Okay, thank you.
All right, most welcome. Yeah. So yeah, that's something I want to highlight. Uh, just a side note that when you read valuation reports or like certain forecasts on the industry, try to read maybe one, not one, but maybe two or three, right? Economists kind of like explanation of the market, etc., so that you get more balanced view, right? Uh, so that's important. Okay, so now we have talked about RI, right, residual income. So now let's shift gears a little to talk about this economic value added. And the idea of economic value added is basically it's RI, but in terms of more FCFF, meaning that we're interested not only in equity, but equity and debt. So just now, RI is more of like FCFF, right? Just the equity component. But now when we talk about EVA, economic value added, is a variation of the RI because now we want to consider both the equity and debt holders. And if you notice the formulation is kind of similar, right? So instead of NI, remember NI, which is net income, we use uh, net operating profit after tax. And we'll look at how we derive this in a bit, right? So don't worry. We'll look at how what's the difference between NI and NOPAT. And now instead of using cost of equity, we use WACC as expected, and also we use instead of just the equity, right? Book value equity, we use total capital because we are now considering both the equity and debt holders here. Okay, that's a good question. That's why I highly recommend using FactSet, or if you have Refinitiv, you have Bloomberg, I don't know, some of you might have Bloomberg from work, etc. I highly recommend to use that. Why? Because usually those platforms explain to you how they do the adjustments to those numbers, right? So yeah, you can use Yahoo Finance, but most of the time they just give you, PE number, or I don't know, what leverage ratio, debt to equity ratio. But when you try to calculate yourself, it's so hard to get it, right? You can't really get the numbers, but you use FactSet. Okay, I know FactSet is for sure, like SUSS have it, but FactSet, they do explain to you, like if you click on the number, they tell you what's the formula, and then I think they might even give you the number being used. So that's how it helps you, right? So if you use Yahoo Finance, unfortunately, because it's free, uh, yeah, or FactSet expired, so I think then they change it to is it Capital IQ, S&P Capital IQ, if I'm not wrong. I saw a notification, yeah. FactSet, I think in the first two lecture was still available, but then the third lecture they changed it to uh S&P Capital IQ, I think. Yeah. Yeah. But I know now SUSS has one. I can check again later at the email, but I know there's access to one platform now. It might not be FactSet, but it might be something else that we can still use, that you can still use. But I think like what you mentioned, you have to request the access from your school. Then they will send you a password or something. But it's part of your school fee, so you should actually just request for it and use it because it's I mean, once you're out of school, you have to pay. It's quite expensive. uh, yeah. Um, okay. Yeah, but yeah, from lecture one. Okay. Yeah, we can. I mean, we can stick to a free one now. Yeah. And maybe don't use their calculated numbers given uh, in Yahoo Finance and calculate numbers yourself, right? At least if you just justify the calculations of the ratios, etc., yourself, that makes more sense. Yeah. Because sometimes you use their numbers, you just So again, I want to highlight, if you're just going to plug their numbers from Yahoo Finance or whatever other platform, it can be any platform, without kind of understanding the numbers, and let's say it varies very differently from the annual report calculated ratios, like if you just put the numbers from annual report, then, and if there's no explanation on how you actually derive those ratios, unfortunately, it's very hard to award you marks from there, and this might impact our valuation in the end. So, yes, you can use a lot of resources that's available, Yahoo Finance, etc., but we need to understand how we get the numbers, and the best, of course, to show your calculations, right? Like working and stuff is the usual stuff, so show workings. Okay, so let's go shift gears back to the lecture. Yeah, okay. Okay, well, yeah.
Because you mentioned with regards to like plugging and pasting number. So I think the the GPA, right? You mentioned that we have to think to like use 30% as our risk-free rate and also use the 6.5% as our MRP. So do we just try and place the number, or do we have to actually find the current risk-free rate as of now? And then also maybe do a blended of the MRP. So not just using the 2.5%. Sorry, not just using the 6.5%. We have to do like the geography breakdown and then using double Daran's ERP and all. So do we have to do that?
Okay, so it's up to you. Because the question gave you that two rates. I saw the question give you the two rates. So you can just treat the rate as good and just use it, right? But if you want to be like I don't know, A star, you get 100 marks, you can do the whole double run and everything that we talked about in detail. You can do both, but there'll be no marks deducted if you just use whatever is the question. Yeah, so rest assured, for groups that have been using the valuation based on the risk-free rate given the question, and I think that is it the equity risk premium given the question, there's no problem. Yeah, but if you want to take the extra step, go for it. And if you have already done the extra step, just leave it there. It'll be there'll be extra marks, right? I would say like bonus marks kind of thing.
Thank you.
All right. Okay, so let's go back to EVA. Of course, at the end of the lecture, we can have more discussion, or if you do have any more questions regarding GPA, we can have a short discussion on that. Let's go back to EVA. So remember, EVA, what we're talking about is the return on capital now. So ROC and cost of capital, right? So no longer equity. So we're talking about capital, which is debt and equity holders. So the concept at the end of the day is the same. Remember, we have the ROE minus ROE minus cost of equity, COE, right? So now it's the same. Return on capital minus cost of capital, multiplied by capital employed, right? So previously it's multiplied by book value of equity. Now we take the capital employed because we talk about the whole capital. And so we can therefore do so-called simplify, multiply in as usual, you the bunny hop, can multiply in the capital employed, we get the NOPAT, and then we get the cost of capital, which is WACC minus the capital employed, right? So you do the bunny hop. Now, let's derive, understand each component of the formula, because sometimes what's NOPAT, what is capital employed? And the tough part is that for most financial statements, they do not show you the NOPAT, right? Net operating profit after tax. They don't show you that. They have the net income, but not the NOPAT. So we need to do adjustments to get the NOPAT. So what is NOPAT? So NOPAT is focusing on operations. So we need to reflect the true cash flow stream rather than the book accounting stream. And so adjustment that need to be made includes the after-tax interest, right? Why? So interest is not relating to operations, right? So what is interest relating to? Anyone knows? So interest is not relating to operations, and what is it relating to? That's correct. Interest is relating to debt, and debt is relating to Yeah, borrowings. Borrowings is relating to what? One more step. Yeah, you're right, on the right track. Financing operation. That's correct. So, in a sense, yes, your finance operation is relating to the capital structure. Remember capital structure? So, when the firm takes on debt, yeah, you take on debt. Like everyone should take on debt, right? Because we understand that debt has a tax shield. If you have 100% equity, is not good. So sometimes taking on debt is to obtain a optimal capital structure. So for example, let's say in the airlines industry, the optimal capital structure is 30% debt, 70% equity. So sometimes company might not need the debt, right? But they are actually trying to obtain or achieve optimal capital structure, and we know why they want to obtain a optimal capital structure, right? Because when we think about the WACC, we know that the debt component is tax. There's a tax shield that we take one minus tax, and therefore this reduce the cost of debt component. So if we take on too much equity, we might actually increase the WACC, right? So there is almost a like a curve, right? So at a certain point at the equilibrium here, with the appropriate debt and equity, our WACC will be the lowest, the cheapest, right? So it's best for the company. So yes, interest relating to debt, debt is related to capital structure, the financing of the business, it's not related to operations. Similarly, deferred tax. So tax is not related to business as well. Whether business doing well or business doing not so well, we still have to pay tax. So we have to adjust for tax. Minority provisions, yes, we have to adjust for this. Remember, if you have already started looking into, or you should have already started looking into the various financial statement, we do have things like minority interest, right? Minority interests are your associated companies, associates meaning less than 50%, or it can be even your joint ventures, right? JVs. So those companies have minority provisionings in the financial statement, but we're not interested in that, right? Because when we are looking at EVA, we are looking at the equity or debt holders, right? And minority interest is not part equity holders. They are just a associate. Amortization, this is relating to non-cash. We don't need to include it because it's non-cash. Why should we include non-cash? Capitalization of R&D. So R&D is intangibles. Again, it's not related to operations. Right? So there are a few things to adjust for. And I want to again highlight to you that these are the recommended adjustments but there can be a list of other adjustments. There you can think about adjustments such as your leases, right? Operating leases, they're not relating to your uh, uh, operations of the business, right? But then they impact your P&L in the sense of they are treated as expenses. So some people would, or some analysts will actually capitalize the operating leases because operating leases is just it's more of PPE, right? So you capitalize operating leases and you remove them from your P&L. So there are a lot of things that can be done um, to adjust to get your NOPAT. Any questions for NOPAT? Okay. So I want to highlight that it will be useful for you to try to see whether you can look through the various line items, the accounting in your whatever company that you are doing, and try to see whether you can derive these things, right? Because these are like these things is in the discount adjustments. And if you do have any question, because sometimes a listed company can have a lot of things that you have never seen before. So, just really feel free to just drop me an email if you're not sure about, oh, what's this thing? What is a mandatory convertible bonds, which we talked about in the last lecture? What are these, right? Of course, you try to read through first. If you don't understand, feel free to reach out to me because there can be a lot of um, um, very specific line items that you can't need to understand in order to do the proper valuation. So capital employed. So capital employed include um, assets used in the business, and actual capital employed is the equity, is the debt. So debt, equity, minority interest, preferred stocks, etc. Whatever that's included. Okay, so this is an important part. Capital employed, we need to use the book value, right? So we're using values in the financial statement. However, WACC, we need to use market value. Now, what's the problem here? That this what's this saying? This is very important. So in the capital employed, if you're going to use the market value, what are you trying to say? You actually bring, we use market value means you are bringing in some more forward-looking kind of value into the capital employed, right? And if we have this forward-looking value in the capital employed and as well as in the WACC, we already know that we need to use market value. We're actually doing a double counting. We're actually being too optimistic or too optimistic or too pessimistic, depending on the market swing, on the valuation, right? Everyone understand this? Why for capital employed we are using book value, and why WACC we always must use market value, right? So yeah, hope everyone understand this. So capital employed, please use the book value numbers from the accounting statement, and WACC use the market value, as we have talked about this in detail for WACC in lecture 2, that we always use market value. So always are. So I want to highlight, if any if you use the book value to calculate WACC, it will unfortunately be a big cross. So I want to highlight that you need to use market value. Don't use book value. Okay, so we do have a simple example here. So we are given EBIT is 8 million, total capital employed is this, debt is 12. Of course, I want to highlight again that this will never come out in your exam because it's just more to illustrate, right? Cost of debt is this, and this cost of debt is pre-tax, so we know that there is a tax shield that is being employed at 17% here. Cost of equity is given at 50%. So how do we derive the NOPAT? We can take you can use the EBIT because it's earnings before tax, and then we do it after tax, right? But we know that this formula, EBIT times 1 minus tax, is kind of actually the net income, right? So in this sense, in this very simple formula, simple case example, there is no difference between the net income and NOPAT here. This is a very, very simple case example. But in real life, when we look at financial statement, we know that there is adjustments that need to be made. All right, when we calculate the WACC here, hope this is not new. Everyone should be able to easily calculate this because we're giving cost of debt, cost of equity. We give them the total capital and what's the debt, so we can count what's equity. We can do that. And then we simply plug in the what is in here. Okay, so usually it's EBITDA, right? So what do you mean by that? I think I know what you mean, but I just want to understand it. What do you mean usually? Okay, no. So that's a good question. So EBITDA is not equals to NOPAT. Okay, so I guess you are saying, is it EBIT? EBIT is equals to NOPAT. Other component. Okay, so these other components is a very big component. And these other components is what we have been talking about here, right? We need to do adjustments here. These are the adjustments that would give you the NOPAT. Yeah. Okay. So at this point in time also, because notepad, if you do need to calculate notepad, can be very, it can be in a sense there is no right way to calculate notepad. There are many formulations of notepad. So one more thing I want to highlight about notepad is that when a company has multiple segments, right? When they have multiple segments, your notepad becomes very complex in the sense because notepad is relating to operations. So if you do have segments that are non-operating segments, then we need to make sure that we do not include those non-operating segments into your notepad calculation. So what does this mean? So for example, if you have let's just give a fictitious example. Okay, we have, let's say, uh, since we're talking about a lot of airline company, let's talk about airline company. So we have an airline company here, all right? And of course, the main business of airline company is to provide carrier for like travels, right? But let's say the company also does leasing of these carriers to other airline company. So you know leasing, right? So that means the airline company have a fleet. I want to lease it out to another airline company, and I earn some revenue from there, right? But wait, should you include this in your notepad? The Should you include the income from the leasing business in your notepad? No, correct, because it's not part of your daily operations, right? Your operations is not leasing business. You're not a leasing business, right? So one of the ways to actually find out what is the core operations of the business is look at the notes to financial statement. Usually the first note will explain to you, they tell you what's the company name, they tell you what's the company address, and what's the main purpose of the business. So always in note one, they have this information, the name, address, registration number, and what's the main business, right? So remember, Notepad is really focused on operations only. So you need to be able to figure out that, oh, okay, if it's a very diversified kind of company, maybe everything can be under Notepad, under operations. But if it's very specific, like I'm just in an airline company, if I have some leasing, or maybe even the airline company, let's say they own some buildings, right? They get some rental income. So that must be excluded for operations because you know that for airline company, your rental income is not part of your operation, your daily operations. Okay, so we have another simple example here. We have this corporation that has a profit after tax of this, book value of debt of this, book value of equity of this. Fine. Cost of debt is 10%, cost of equity is this, stock sales at 52. There are 10 million shares outstanding, calculate the EVA and market value added. So MVA is market value added for this company. All right, so we do the WACC calculation as usual because we are given the book value of that, book value of equity, and we know that of course we should not use the book values, right? And when this is a very simple example, we should always use market values. All right, and then we are able to calculate the EVA. Again, these are very they already give you the notepad, so it's fine. And calculate it. So 400, this one is basically just 150 plus 200, right? Your capital employed, your total capital employed. Now, once we calculate what's the EVA, economic value added, then what we can do, because we know that we have this amount of debt, we have this amount of equity, right? So we can calculate what's the value of the firm. So if we take the value of the firm, which is given here, right? Minus away what is the capital employed, which is 400, right? This is the capital employed. Then we can actually find out what is the market value added to the firm. And the value added is this. Okay, so there are some more like kind of explanation on EVA. EVA is good because it closely relates to MPV. Avoids the problem associated with focusing on spread between ROE and cost of equity. And this. So because EVA focus on enterprise value added, right? It kind of move away from more, what's it called, uh, um, KPIs based on, let's say, ROE, right? ROE is kind of like usually a bad KPI that's been used to assess managers. So you move away from that, it might improve the decision making uh, in the firm. And we know that by taking into account enterprise added, we actually remove remember the interest and stuff that we talk about, interest, deferred tax, etc. And those relates more to like financing decision, capital structure, right? Things that are kind of not really relating to the operations of the business. So by looking at EVA, we really just focus on the operation of the business and how well the managers are actually operating the business. So that's why EVA is usually being used. So this is some explanation. All right. So, I think now is a good time to take a break. Let's say a 10 minutes break. Maybe we'll come back at 8:23, if that's okay. Um, before we go on to technical analysis. Right. So we are done now. Okay, so at this point in time, we are completely done with your valuation methods. Right. So next part is more the technical analysis, which is totally different from valuation. Right. So we're done with all your quantitative valuation methods. Okay, so all right, so we'll take a break. Any questions? Again, put in the group chat on valuation, GBA, if you do have any, then we'll come back in a bit in 8:23. All right, so welcome back from the short break. All right, so we have a question here, I think, for ECAD record. Yeah, okay. Um, okay, so I think we have a question here regarding the ECA on the video recording. Let me just check with this with the course coordinator, and then if I think he will release a announcement on this since it's not mentioned. Okay. So I'll get back to you on video recording. All right, so I guess there are no questions regarding valuation so far. Let's jump into technical analysis now. At the end of the lecture, I think we might have a bit of time. We can still go through a bit of things about, let's say, GDA or valuation in general. So let's look at technical analysis. So now we're going to shift gears towards away from valuation and towards a more trading. So I believe some of you all might have already tried your hands on trading of like stocks, or whether is it a basket, uh, index, or like individual stocks, right? So in technical analysis, the main interest of this is to understand the movement uh, of financial products, right? The price movement. Uh, by examining, whether the past movement and try to forecast what kind of movement will happen in the future. What is likely to happen. It's linked to the Doan theory. Charles Doan generally believed to have successfully signaled the market correction. This is some example explanation. So some assumptions that is important in technical analysis is that, first of all, price is not important. So at what price you enter the market, or what is the price today is not important, because what we're interested in is price change, right? Only when there's price change can you actually make a profit, or do you actually make a loss, right? So price change is important. Market actions, market will kind of discount everything. What does this mean? It means that the market will take into account all the information that's available, right? And pull it in. It can be, supply and demand factors, it can be political, psychological, etc. So by looking at the market itself, we can easily kind of pass out, right? What is the supposed price, and therefore what profit or loss you can make. Profit. We don't want to make loss, of course. And then we know that history repeats itself. What does it mean? It means that, as we talk about in lecture one, there are various economic cycles, right, that happens. So if it's a downward cycle, it's likely that the cycle go up in the future, right? So there is usually a reversal that will happen. So we try to predict a reversal, usually the reversal trends that we're interested to predict. And we know that also price move in certain trends. What does it mean? If a stock keep on going up one day, right, in a single day, most likely the next day there might be a correction, right? There might be a drop. So it's a correction towards some kind of baseline, uh, which we will talk about more in detail, right? So there might be some correction that will happen. However, if the correction has already happened, most likely the stock will increase in price after that. We try to identify some of the trends, whether it's a new trend or existing trend. Uh, So a trend is most likely to continue rather than reverse, unless we know that a reversal trend is happening. And we'll talk about what's a reversal trend in a bit. So when we look at price movement, generally they persist for a long time. For example, we can have things like this go down but up. So generally there is an upwards trend here. So it can't persist for a long time. So a technical analyst would look at the trends, try to uh, forecast what will happen next, and try to make a profit out of it. Of course, when we look about trading, what's important is that there is volume trade. So in all technical analysis, what we're interested in is volume trading, meaning what? There is high volume of that stock being traded. If it's a low volume trade kind of trend, that is not important for technical analysts, right? Because we want to look at what is the change in the price when there is high volume of that particular stock being traded. So this is what's meant here. Price change are accompanied by high volume, and therefore this price change has meaning. Only when the price change is accompanied by high volume. Just some advantages. Can have a look at it. It's quick, easy. Does not import data. Just look at charts. It tell you when to buy but not why. So this is important. When but not why. So the why is using the valuation, right? Valuation methods that we talk about. FCFE, FCFF, RI, DDM. So those are the whys, right? But when to buy is given by your technical analysis. I want to highlight at this point that the when to buy is not so important if you're going to value a stock, whether is it to do an M&A acquisition, or whether is it to be a minority shareholder, or to just hold the stock, right? So it's the when is not important, because in those various cases, you typically hold the stock for at least 3 years, right? Or more than 2 years at least, right? So those are not so important. But the when to buy becomes important when you're holding a stock for, let's say, 1 month or 2 weeks, right? Then the when to enter the market, when to buy, and then how long to hold becomes very important. That's where technical analysis comes in. Of course, some naysayers would say that, oh, the market is not efficient, and so it might not include all the information that is presently available for the company in the stock, right? Some people might say that. If it works, it will self-destruct, meaning that if everyone can make profit, then it doesn't make sense, right? Then everyone will be trading on stock. It's too subjective to be used. So these are some things. So tools that we'll use, we'll look at these chart trends and patterns. All right, so let's talk about some general movements of stock first. So the general movement, we have the primary, secondary, and ripple, which is the short term. So primary is more of a long-term trend. So what's happening in about 1 to 3 years? And we'll look at a graph in the next slide to explain more. Secondary is more of the movement against the primary. So as the primary go up, mostly go up, there might be some secondary go down. So this is like the secondary, right? There's some downwards correction. Ripple is more of the daily fluctuation, which is generally not important for a technical analyst. So we have a good example that we are explaining the trends here. So what's happening here? So we can see that the primary trend is bearish in the sense that it's going down, right? You can see that generally it's going down. We notice a few secondary trends here, right? There's some upwards of going up. And then we notice that there are very daily ripples that's happening. So all these are ripples, right? There are ripples like just up, down, up, down. Right? So these are some the 3 key stock movement that we can classify. All right, a line chart. So a line chart basically gives you the price, right? As you can see here, the price of the stock. it does, but it does not really provide more than just the price, right? It's just the price of the stock. Okay, a bar graph. So this a bar chart is quite interesting. So you might actually see this on FactSet or I think FactSet no, but maybe Bloomberg. Bloomberg will have it. So Bloomberg, you will be able to see that, hey, you know what? There are some of these lines, or these things. So what does it mean? So the line gives you the highest price. So highest line. The line for the day. So this 1 day, right? 1 day will have this one line. Uh, the the line here is the lowest, the opening price, and the closing price. So this gives you the price movement within the day. But at the same time, given that you have various lines, we can kind of tell what is the primary trend as well in a bar chart. So before I continue on, you'll see a lot of different charts. At the end of the day, these are just trying to introduce you to the various tools that a technical analyst would want to use or can try to use. Usually you use a variety of tools to do trading. So if anyone interested in doing working in a bank in like the global markets division, which is generally the trading division, usually some of them will use this kind of tools to help them forecast when to enter the market or how to do the trades, right? So all we are going to talk about the remaining of lectures are just a lot of tools. A candlestick chart, this is used quite often and is very popular. And it's first created, referred to a Japanese candlestick, was first used in Japan and price of rice contracts. So how do you read this candlestick chart? So there are first two colors, either is a green or red. And with green is always good, red is bad, right? When a green happens, what does it mean? It means that it means this is the low, this is the high, open and close. So that means the open is below the close. So that means at closing price is higher. So it's positive, right? So it's green. Now, what happens if the candlestick is a red? It means that the open is above the close. So it means it closed at a lower price. And therefore it's bad for the day, right? So it's red for the day. So that's how we see the red green or candlestick. And so this is an example of a candlestick chart. We can see some reds, some greens. Of course, the greens are the good ones. The reds are not so good because it's going down. And so now so those are the charts. So now we are trying to look at trends. So what can you see here? Oh, you can see there's an upwards trend, and we can see that the secondary, so these are secondary movement, right? We talk about the various movements. So the primary movement is upwards, which is good. We can see some secondary movement going down, and then there's usually a correction upwards. So perhaps when the secondary movement ends, right? That means end here, the secondary movement end here, there is upwards correction. So perhaps whenever we forecast and we notice a secondary movement ending as a technical analyst, you should actually buy the stock, right? So we buy here, we buy here, we buy, right? Whenever the secondary movement ends. Okay, so that is trend. Now let's look at patterns. So we have this thing called support and resistance. And what does it mean? It means that the support is basically the floor, right? So what is supporting the bottom, the foundation? What's the resistance? The resistance is basically the ceiling. So it's going to resist the price. And we can see what does this mean in a bit. So this is the explanation here. What's a support? What's a resistance? So what does this mean? Okay, let's look at support and resistance. So in this price movement here, so there's quite a lot of stuff happening, but let's look at the price movement. So at this price movement here like this, we can tell that the support is below, right? This is support. We are support. This is the major support. And we can say that the resistance here. Why? Because the price actually never X like cut out of the resistance level. It never goes up like this, right? It's always just between this and this, which is the bottom is the support and the top is the resistance. Now, why is this important? Because if we are able to determine the support and resistance, then we are able to forecast. This provides us some kind of pattern to forecast what happens next. So here in this diagram, you mentioned that there's some minor resistance and there's some minor support. So what does this mean? You can tell that, oh, here there's a bit of resistance here, some resistance, and some support here, right? So whenever it hits a support, we know that after hitting a support or let's say a minor support, it will shoot up, right? And of course, when it hit a resistance, it will go down. So it kind of like tell us, oh, when should we buy, when should we sell, etc. So this is another example of a support and resistance, how we can use it, how do you can use this pattern to forecast certain things. For example, what happens if a stock breaks below the support? So if it cut below the support, it means that, hey, there might be a primary downwards trend already, right? So the support now will become a new resistance level. So previously this was the support, but now it became a resistance, and now it moved in this area here, right? And then this becomes the support, the new support, right? And this is the resistance. Now, again, if it cuts, again, can you see that? Let me use a different color. It cuts down below the support. When it cuts below the support, what happens? This support now becomes the resistance, and then probably there is a new support here. So what I mentioned here is that, if there is a breakdown, it's usually considered a bearish signal, which is what we can see here. When it cuts down into the support, it's considered bearish, right? Because, we kind of notice that, hey, you know what, the primary trend is going downwards, right? So it's a bearish primary trend. Any questions at this point in time before we move on to continuation? Okay. So all these a technical analysis kind of charts. They are really more for FYI. Unless you're really into technical analysis, sometimes you might even formulate your own pattern. So these are more like general ones that are typically being used. Okay, so there are many others, like infinite number. But yeah, usually people create their own patterns. Okay, continuation pattern. What does this mean? So in the continuation pattern, it actually shows that the trend kind of would continue after this pattern is being identified, right? So what is this adjacent uh triangles? So what does this adjacent triangle means? It means that it is considered a more of a bullish kind of continuation. And how do we identify this pattern? It is a flat top and a slanted bottom, upward slanted bottom. So whenever we see this kind of triangle, a flat top with a slanted bottom, and the price go in this triangle like this, it's likely that it will cut out of the triangle in a continuation, meaning that because the the slant top is going upwards, so the price would likely keep on going upwards. So this is a bullish kind of sentiments in the market. Now, if on the reverse we see a descending type of triangle where there is a flat bottom and slanted top, what this means that price is going like this, and then most likely a cut down, right? So in general, there is a downwards trend. There is a bearish trend in the market. And then we can have this thing called symmetrical triangle. Symmetrical meaning that it's like, oh, it's very symmetrical, right? Oh, it's like, oh, okay, so it's going up and down. So it shows that the price is kind of like indecisive. They do not know whether it's going up or going down. So eventually it might either explode up or it explode down. Oh, insider. So the thing about insider information is that it really depends on what you believe in. So if you're a technical analyst, right, and you believe in technical analysis in general, it means that whatever insider information will be efficiently incorporated in the price already. So in a sense, it can be very hard to identify the trends. Okay, so usually insider information is used for valuation and not technical analysis. Right? Because technical analysis is the price are moving so fast, right? So generally, because they are moving so fast, insider information has limited purpose, right? Remember just now we talked about what is important for technical analysis is more like volume trades, we are talking about price movement, etc. Right? So when you have insider information, it's more relating to things like valuation of a company and all, but of course it can impact a trader as well. But in terms of a pattern relating to insider, I do not think there is. But perhaps if you do Google it, you might find something because for technical analysis, really there is infinite number of patterns, and the ones that we're covering today is just like the I would say the old school pattern. Because nowadays with the market going quite crazy, we have the war and all, things can become quite crazy. The fluctuations are quite crazy, right? So there are a lot of new patterns nowadays. So, if you are a technical analyst, you can even create your own pattern. And if that pattern makes you big money, of course, you make a lot of money, right? Yeah, you should go work for a bank or something. So, a good technical analyst can actually make very good money, right? And most of them use their own variation of patterns uh, to create certain value, right? That they see, others do not see. Okay, so a continuation pattern, what it means that if it's going in that direction, you continue in that direction. So we do have two kind of flags that we like to talk about. And this flag is called a bullish flag or a bearish flag. So what does this flag means? So it kind of looks like a flag, right? Like a flag pole, right? Like a flag pole like this. It's like a flag pole. Yeah, the flag. Then this is the ground, right? So a flag on the ground. So what does this mean? It means that it's characterized by low top, a lower top and a very high uh, there is a sudden upwards trend and then a very high top here, right? So this is a bullish flag, and then a bearish flag is a high top, but then it drops down to a low bottom here. So these are a flag, and it's a continuation pattern. So if you do see things like, so what does this mean actually? So if you do see certain movement like this, so you see some certain movement like it's going here, and then maybe it's dipping a bit already. So you know that, hey, you know what? If the price is moving like this and slightly dipping, you might be signaling a bearish flag, and so you want to sell quickly at this point in time, right? Because it might just drop down and go lower here like that. However, on the reverse, if you do see a bullish flag, if you know price is kind of going below the average, we know that, hey, you know what, maybe it'll spike up. As it's spiking up, we know that, okay, you know what, this is a bullish flag, then it's time to buy here so you can earn some profits here in this region. Other kind of continuation pattern, we do have a pennant, which is something like a flag here, and then a symmetrical triangle, meaning that is just going up and down, up and down, up and down, and it spikes up out of the triangle here. All right, so those are continuation patterns. Now we have things like reversal patterns. So reversal patterns would mean that after you reach certain peaks, it will reverse. In this sense, it's a double top, right? But what happens in double top? It's like an M shape. So when it goes up like this, you know it's going down. So once it hits the peak, it's going down. And then if you go up again, you know it's going down, right? So there are some reversal. So we try to identify the reversal, and if we ever identify reversal, then we should buy here, and we try to sell here, right? And this is the neckline. And so this is a double top, and we have a triple top, and this here, double bottom is really a lot of variety. So in this sense, double bottom means that it will go down like this, almost like a W shape. And in this double the bottom, we try to identify where is the bottom, which is the crest, right? The crest and chop. So we identify what's at the bottom, and then we able to see when it will reverse, price will reverse. So this is a triple top that I talk about. There can be four top, quadruple top. I mean, there's a lot of different patterns, and, and it's really how we want to use it. And so even here, we can see certain kind of resistance, and this is support, right? And then when we can kind of put different technical analysis in. So this is top, sorry, this is the resistance. This is support, and this is resistance, is the support. And once it cuts below support, we know that, hey, you know what, there is a bearish trend happening. So we are actually using the support and resistance, support and resistance and reversal pattern to do this trade, for example. So we want to, let's say, sell, 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 buy, buy, sell, right? Because if we know that it is going to cut below the support, we want to sell because we know that a bearish trend is going to happen soon. Another kind of reversal pattern is your head and shoulder. So we'll have a look at it in a bit. We can see four distinct parts here: left shoulder, head, right shoulder, and a neckline. And let's see what is it in this diagram. So it looks like a mountain. Okay. You have your left shoulder, which is the left peak, which you see here, left shoulder. Okay. And then we have the head, which is the highest peak. And then we have the right shoulder, which is like the low peak here on the right. And then the neckline is usually this upwards trend, right? That we see. So these are kind of like explanation of the left, right, head and shoulders. So there is a normal head and shoulder. There's an inverse head and shoulder as well. It goes downwards. Yeah. Uh, as you can see here. The neckline can be a straight neckline, or maybe it can be a incline or decline neckline, right? So that's different type of necklines. Okay, so we do have other things like relative strength indicator. And what does this mean? So this one is quite interesting. Actually, the good thing, I don't know whether not so good thing, but if any of you are taking the CFA, you might know that you have to do calculations for this. How do you calculate the RSI, and then you also need to calculate the MACD, right? As in you need to know how to write down the formulas to calculate it. But for the purpose of this course, the good thing is that you don't need to, you just need to understand how to use it. Because the calculation actually can be quite complex. Okay, So in your RSI, it ranges from um, uh, 0 to 100. And let's see what this means. If the RSI, relative strength indicator, approaches 70, right, it means that it's being overvalued and it's a good indicator for a pullback, right? It's valued too much, right? So it's likely that we have pullback. If it approaches 30, it means that it's an oversold position and it becomes undervalued. So what does it mean? So this is the RSI here, right? RSI is here. We have these two lines given at 70 and we have this line given at 30 here. Okay, so a good rule to watch is, okay, let's see where are we. If this price is, okay, this is different color. If it's going down like this, so can you see this is a oversold position, means that it's slightly undervalued. Means what? If you notice your RSI um, calculation, it has gone below the 30 mark, means that it's likely going to go up. So you want to buy. Now, in a case where it is approaching 70, meaning there's an overbought position, likely that you want to quickly sell because your price will be going down after this. So your RSI kind of help you model the price movement, which is given right here, as you can see, because these are being given here. Can you see? So these are RSI and these are your price. So these are RSI. So by using RSI, you can kind of predict what kind of position you're at, whether you're overbought position or you're oversold position. So again, I repeat, how do you even calculate this RSI is beyond this course, but if you're interested, do a simple Google search. And if you are doing the CFA level 2, you will need to know how to do this, how to calculate RSI. Now, a very another common indicator to use is this thing called MACD. Anyone heard of this before? MACD? I believe if you use Bloomberg, you should probably have heard of this. Moving averages. Yeah. Yeah. So this is very popular. A lot of people like use RSI and MACD. Okay. Oh, that's good. Then this should be, you probably would know more than me if you have been using indicators or like even doing trades yourself and using this kind of technical analysis. All right. Okay. So in terms of MACD, let's look at this. So what is MACD? So it's a moving average convergence and divergence. And we want to basically see the difference. What we're trying to see? We're trying to see a difference between a 26-day and 12-day exponential moving average, right? And by comparing the difference between the 26-day and 12-day exponential moving average, we are able to determine how the price of the stock is going to pan out in the future. So in this sense, we normally compare with a 9-day exponential moving average for the MACD. And if there is a crossover above the 9 days exponential moving average, it's a buy signal. If there is a movement below the 9-day exponential moving average, there's a sell signal. And so I guess most of you who have not ever seen this before is like, oh, okay, so it seems quite easy. Now the calculation, like how do you even get this 12 days, 26-day, 9-day moving averages? Basically, there's formulas for it to actually calculate and what generally does. So I'm trying to just explain like more of the intuition because you don't need to know the calculations at all. What it generally does is that as your number of days moving average increases, what you notice, okay, I'm just going to flip over here. As the number of days increases, you are taking more fluctuation into your line, right? So let's say a 12 days moving average would look like this. Let's say a 12 days looks like this. Now, if you take a 9-day moving average, which is lower, your graph becomes smoother, right? Because you taking exponential. Whenever you take an exponential function, you tend to smooth out. And when you take in less days, it becomes smoother. So it becomes smoother. So you can even take so this in this case, they only consider 12, 26, and 9 days. You can do anything you want. You can do a 10 days moving average, or you can do a 2-day moving average. Of course, if you do a 2-day moving average, maybe it will look something like this, like super smooth, right? And maybe there's no meaning after all. So generally, they use a 12 days or 26 days compared with a 9-day moving average. Okay, so once we are, of course, the moving average calculated using the stock price, all right? And again, we don't need to know how to do that, but it's being used using a stock price, we're able to calculate moving averages. And so once we are able, so we are using all the stock price, let me just, so all these are stock prices, right? So we use the stock price to calculate these two lines. So the 9-day here and the difference between the 12 and 26 day, right? So this line is the difference, and this other line is the 9-day. And what does this mean? It means that whenever the difference in the 12 and 26 day moving at exponential moving average cuts the MACD from the bottom and cuts up, what does the signal say? It is I'm just going to flip back here. It is a buy signal, right? We want to buy. So whenever it cuts from the bottom, it's a buy. Now, what happens when it cuts from the top going to down the bottom, when the difference between the 12 and 26 day cuts the 9-day from the top going down the bottom, it is a sell signal. So it's a C, it's a sell here, right? With bottom. So this is how we use the MACD to determine what to do, whether to buy or sell. Any questions for this? MACD and um, RSI. All right. So if there are no questions, then let's just do a quick recap of what we have discussed, right? What's the difference between technical analysis and fundamental analysis, right? At the end of the day, I want to highlight that before we go through this, just a summary slide. Most of these course, or say 90%, 80 or 85% of the course, we are really focusing on fundamental analysis, right? So if you want to be a trader, I'm not sure whether the technical analysis course at SUSS, but if you are interested in being a trader, then you should really focus on technical analysis. But in most cases, let's say if you want to work in M&A, if you want to do investment banking, these are mostly fundamental analysis based or derivative of fundamental analysis, right? That means like different components of fundamental analysis. And what we have learned so far is like the basis of fundamental analysis, right? And that's what we have been talking about for the last 4 lectures or 4.5 lectures, including this. And for technical analysis, we are just using half a lecture to cover it. So like next lecture, we're no longer talking about technical analysis anymore. Okay, so what are some differences here? Let's just go through it. Fundamental analysis, we're looking at value. Technical analysis, remember, we don't care about the price, but we only care about the price change, right? The change in price, because that will create profit for us. Now, in terms of risk, fundamental analysis, we do consider the risk of cash flows. We talk about the cost of risk for equity and WACC, which is the cost of risk of capital. Now, for technical analysis, what we're interested in terms of risk is more of the volume trade, right? We want to trade at a high volume trade scenario, and there's little meaning for a low volume trade scenario whenever we do technical analysis. Profits. So in fundamental analysis, what we're trying to remember at the end of the day, for any valuation report that you have done, you need to come up with a opinion. Is your stock overvalued or undervalued? And if it's overvalued, then maybe you should invest in the company. Sorry, overvalued means you should sell. Undervalued means that you should invest, right? You invest, you do M&A, you do whatever, right? That's the purpose of fundamental analysis here. Now, in terms of technical analysis, we don't care about overvalued, undervalued. We just look at the price, right? And the price change. In terms of period, usually fundamental analysis, we have a long time horizon, like at least 2, 3, 4, 5 years. Technical analysis can be as short as just a couple of hours, a week, or 2 weeks. Type of information. This one, remember, for fundamental analysis, remember I spoke earlier that we need a lot of information. We need financial statement, we need cash flow, we want to predict the WACC, cost of equity, etc. There's so many things we need. Technical analysis is easy in the sense that we just need price and volume. Issues is for fundamental analysis, remember, we need to give a lot of justification. So whenever you do a valuation report, make sure that you give a proper justification on certain assumptions that you make. For example, you say revenue is going to grow at 10%, perpetual growth at 10%. So we need to give justification. Why is it 10%? Why is it not 9%? Why not 9.5? Why not 8.5? Or why not 10.5 or 10.2? Right? So we need to give a lot of justification in our estimation for whether is it the cash flows, whether is it the growth factor. Right? So this is one of the big issue here. And then for technical analysis, the issue is usually to come up with your own pattern and strategy, right? There is no right strategy for technical analysis. Usually, you just formulate your own, or you combine various existing ones, like just now what we did a little in terms of the head and shoulder, as well as the resistance and support, right? So you combine various methods. Okay, so that's all for technical analysis. So it's just really a brief overview. Any questions at this point in general for technical analysis, or any questions for fundamental analysis in terms of what we have covered for free cash flow, dividends, and RI today? So this is kind of the end of lecture 5. In a sense, we covered the topics. So I'm happy to use the time for any questions. If you do notice, we have some self-practice questions. So these are just some examples of RI that I think, and I mean, there's also answers given that are quite good to just practice to kind of understand how do you calculate RI, right? So these are some examples here. And with solutions provided. Okay. All right. So, any clarifications we need? Happy to use this time for some any discussion that you would like to have. Pause the recording as well. I think this is the end of the lecture.